Hey everyone. Looks like we're going deep on finance and economics again this week.
Always a good time for that.
You know it. I even brought in some Graham Stephan for this deep dive, that urgent warning for all investors video. It really
Mhm.
got me thinking, with all the stuff about tariffs and the stock market being kind of shaky.
Yeah, he definitely doesn't sugarcoat things. Always good for a reality check.
Right. And Bitcoin too. It's like, where do we even start?
Well, maybe we start with what stood out most to you. What really caught your eye and all that?
Hmm. Well, tariffs for sure. I mean, Stephen's pretty worried about Trump's tariffs. Like higher prices for everything, other countries getting mad and fighting back.
Retaliation, yeah.
Yeah, exactly. And then the whole thing could just spiral,
Uh,
right? Slower economic growth, less competition, less innovation. I mean, it sounds kind of scary.
Well, tariffs have always been a bit of a double-edged sword. They've been used for ages to protect domestic industries, but they can definitely backfire.
So is this like a potential trade war situation?
Yeah.
Kind of like the Smoot-Hawley Tariff Act back in the 1930s?
A lot of people are making that comparison. Smoot-Hawley is kind of a cautionary tale, right? It definitely contributed to the Great Depression, even if it wasn't the sole cause.
Right, right. So how do we actually apply this to our own lives? Like, what should people be thinking about with all this tariff talk?
It's all about connecting those big global trends to your own spending. Like, what do you buy regularly that's imported? Could those things get pricier?
Okay, so like if you're always buying imported clothes, you might want to start thinking about whether you can find good alternatives made domestically.
Exactly. It's about being aware and maybe making some adjustments if you need to.
Makes sense.
Yeah.
Okay, so let's move on to the stock market because Stefan had this crazy stat. Only 28% of the stocks in the S&P 500 are actually doing better than the index itself.
It's a pretty stark number.
Yeah, and he says most of the profits are all jammed up in like the top 7 companies. Kind of feels like a house of cards.
It's a valid concern. This concentration of market power is pretty unusual historically, and it definitely brings some risks.
Especially if one or two of those big companies have a bad year, right?
Exactly. It could trigger a much bigger correction across the whole market.
Stephen even compared it to the dot-com bubble, like
Oh.
specifically Cisco back in the early 2000s. He was talking about how revenue growth is slowing down and how people might be getting a little too excited about AI. Kind of reminds me of all that hype around internet companies back then.
Well, there are some parallels for sure. The dot-com bubble was all about excessive speculation. Valuations were through the roof, and then reality hit. Growth slowed, the bubble burst, and we saw a massive market correction.
Right, and everyone who had poured their life savings into pets.com was left holding the bag.
It's a good reminder to be cautious and not get caught up in the hype, no matter how exciting a new technology seems.
He also mentioned something called pulled forward growth, which honestly went over my head a bit.
Think of it like this. Imagine a company that saw huge growth during the pandemic because everyone was stuck at home.
Okay, like those companies that sell workout equipment or streaming services.
Exactly. But as things went back to normal, that growth slowed down. That initial surge was basically borrowed from future growth, and now they're facing a correction.
Oh, I see. So what does all this mean for like regular people who are invested in the stock market?
hmm
Should we be freaking out about those top 7 companies?
Freaking out is never the answer, but it is a good time to review your portfolio. If you're heavily invested in just a handful of companies, you might be taking on more risk than you realize.
So diversification is key.
Always. It's not just about spreading your money across different companies, it's also about different sectors, different types of assets.
Like stocks, bonds, real estate, that kind of thing.
Exactly. And don't forget about international investments, too.
Right. It's all about not putting all your eggs in one basket.
Exactly. And having a plan, knowing your risk tolerance and what you're comfortable with.
Okay, got it. Now let's talk about the Federal Reserve and interest rates. Stephen mentioned that everyone was expecting rate cuts, but it doesn't look so certain anymore.
Yeah, the Fed's in a tricky spot right now.
He even mentioned stagflation, which honestly sends chills down my spine. What's going on there?
Well, the Fed's main job is to keep inflation under control. They do that by messing with interest rates. When inflation's high, they usually raise rates to cool things down.
So why aren't they cutting rates now if everyone's expecting it?
Inflation's been stubbornly high. Normally, that would mean rate hikes. But the economy is showing signs of slowing down, too.
So raising rates too much could make things even worse.
Exactly. It's a delicate balancing act.
And stagflation is like the worst case scenario.
Pretty much. High inflation, high unemployment, no economic growth. It's a tough situation to get out of.
So how does this all affect us On a personal level, like how do these rising interest rates hit our wallets?
Well, think about things like loans, mortgages, car loans, even just using your credit card. Higher interest rates mean higher costs for borrowing money.
Oof, that doesn't sound good. What about investments? Do higher interest rates mess with those too?
They can. Bonds start looking more appealing because they offer a fixed return, unlike the stock market, which is always a gamble.
And companies have to pay more to borrow money, right?
Right.
So their profits take a hit, and that can make their stock prices drop.
You got it. It's a complex web of interconnected factors.
This is a lot to wrap our heads around, but it sounds like staying informed is key.
Absolutely. The more you understand, the better decisions you can make.
Okay, so let's lighten things up a bit with some Bitcoin talk. Stephen was diving into that recent Bitcoin downturn. He was talking about how the price dropped, the whole Trump excitement fading, and even the possibility of a Bitcoin bear market. I thought Bitcoin was supposed to be the future of finance.
The cryptocurrency market is a wild ride. Prices can swing dramatically in both directions.
So is this drop just a blip, or is something bigger happening? Stephen even said something about waning investor enthusiasm. Sounds like the party might be over.
It's hard to say for sure. Remember, a lot of the hype around Bitcoin was based on speculation.
Yeah, that it would revolutionize everything?
Right. But like any new technology, it faces its own set of challenges and growing pains.
So if you're thinking about dipping your toes into the crypto pool, what should you make of all this? Is it a chance to buy low or a sign to stay away?
Crypto is definitely a high-risk, high-reward game. You need to really understand the technology, the risks, and, importantly, only invest what you can afford to lose.
No using your rent money to buy Bitcoin.
Definitely not a good idea. Never invest more than you can afford to lose, especially with something as volatile as cryptocurrency.
Solid advice. Okay, so we've covered tariffs, the stock market, the Federal Reserve, and even Bitcoin. It feels like there's a lot to worry about out there.
There's always something, right? But the good news is that Stefan offers some practical advice for navigating these uncertain times.
Okay, I'm all ears. What's his secret sauce for staying afloat in this sea of financial chaos?
His advice is surprisingly simple and straightforward. It's not about fancy financial strategies or trying to time the market.
So, no need to become a day trader.
Not at all. It's about building a strong financial foundation that can withstand any storm.
Okay, I like the sound of that. So what's step one?
He starts with the absolute bedrock of personal finance, building an emergency fund.
The good old emergency fund. It's like the financial equivalent of brushing your teeth.
Yeah.
Everyone knows they should do it, but not everyone does.
Exactly. But it's so important, especially during times of economic uncertainty. Having 3 to 6 months worth of living expenses stashed away in a safe, liquid account can give you a cushion to fall back on if you lose your job, face unexpected expenses, or encounter other financial challenges.
It's like having a safety net so you don't have to panic and make rash decisions when things get tough.
Precisely. It's about having that peace of mind, knowing you can weather the storm without jeopardizing your long-term financial goals.
Okay, so emergency fund check. What's next on Stefan's list?
Next up is diversification. It's like that old saying, don't put all your eggs in one basket.
Diversification. I think I've heard that one before too. But it's one of those things that's easier said than done, right?
You're absolutely right. It can be challenging to figure out how to diversify effectively. But the basic idea is to spread your investments across different asset classes, sectors, and even geographic regions. This way, if one area of the market takes a hit, your entire portfolio isn't wiped out.
Stefan uses some pretty stark examples to illustrate this point. He talks about the dot-com bubble, where tech stocks lost a whopping 78% of their value. And then there was the 2018 crypto crash, where some coins plummeted by 85%.
Ouch! Those are definitely cautionary tales. They highlight the importance of not putting all your eggs in one basket, so to speak. Diversification helps to mitigate those risks by ensuring that a downturn in one area doesn't derail your entire financial plan.
Okay, diversification, got it. What else does Stefan recommend?
This one might seem counterintuitive, but he actually advocates for continuing to buy in even when the market is down.
Wait, hold on. Isn't that like catching a falling knife? I mean, it feels like you could get really hurt doing that.
It can feel that way, but it's actually a core principle of value investing. The idea is to buy assets when they're undervalued, which often happens during market downturns. This strategy requires a long-term perspective and the discipline to stick to your investment plan even when emotions are running high.
So you're saying that when everyone else is running for the hills, that's actually the time to be greedy.
Well, not exactly greedy. It's more about being opportunistic and recognizing that market downturns can create buying opportunities for patient investors.
Okay, I can see the logic there. But it still takes a lot of courage to buy when everything seems to be falling apart.
You're right, it does. It goes against our natural instincts. But remember, the same fear that drives people to sell when the market is down also prevents them from buying back in when it starts to recover. They miss out on the rebound entirely.
It's like they're selling low and buying high, which is the opposite of what you want to do in investing.
Exactly. And it all comes down to managing your emotions and making rational decisions based on your long-term goals, rather than reacting impulsively to short-term market fluctuation.
Okay, so we've got our emergency fund, we're diversified, and we're buying in even when it's scary. What else does Stefan recommend?
He emphasizes the importance of avoiding panic selling when the market drops. It's natural to feel scared when your investments are losing value, but selling everything in a panic often leads to locking in losses and missing out on potential rebounds.
So it's all about staying calm and sticking to your plan, even when things get rough.
Exactly. He also highlights the value of maintaining a steady income, staying out of margin and debt, and keeping short-term savings safe and accessible.
He specifically warns against borrowing money to invest, especially in volatile assets like stocks or cryptocurrencies.
That's a recipe for disaster if the market takes a turn for the worse.
His final piece of advice is to keep short-term savings safe. He points out that if you need access to your money in the next 3 to 5 years, it's probably not a good idea to have it invested in the stock market.
That's because the stock market can be unpredictable in the short term. While it tends to go up over the long run, there can be significant fluctuations along the way. If you need to withdraw your money during a downturn, you could end up selling at a loss. It's better to keep those funds in a safe, liquid account like a high-yield savings account or a short-term CD, where they're protected from market volatility.
Okay, so Stephen lays out a pretty clear roadmap for navigating market uncertainty. He emphasizes the importance of staying calm, sticking to your plan, and making rational decisions based on your individual circumstances and financial goals.
He also acknowledges that this advice might seem repetitive or even boring, but it's precisely because it works. The slow, steady, boring approach to investing has a proven track record of success over the long term.
He even makes a bold claim. If you hold the S&P 500 for 20 years, you're practically guaranteed to make money. He backs it up by saying that over a 20-year period, the S&P 500 has never produced a negative return.
It's a powerful statement that highlights the importance of a long-term perspective. However, it's essential to remember that past performance is not necessarily indicative of future results. There are no guarantees in investing.
But wait, if he's so confident in the long-term performance of the S&P 500, why is he even warning people about potential market risks? It seems a bit contradictory.
That's a great question, and it raises an important point about the difference between long-term trends and short-term fluctuations. While the stock market tends to go up over the long run, it can experience significant downturns along the way.
So he's not saying that the market can't fall 20% or 30% in the short term. He's saying that even if it does, history suggests it will eventually recover and continue to grow over the long run.
Precisely. His message is not about trying to time the market or predict short-term movements. It's about building a resilient financial foundation that can withstand volatility and allow you to stay invested for the long haul.
His overall message seems to be, don't panic, stay the course, and focus on what you can control.
Exactly. And remember, investing is a marathon, not a sprint. The key to success is to stay informed, make informed decisions, and be patient.
So we've covered a lot of ground in this deep dive. We've explored the potential impacts of tariffs, the risks and opportunities in the stock market, the role of the Federal Reserve, the volatility of Bitcoin, and Stephen's advice for navigating these uncertain times.
What stands out to you from all of this information? What resonates most with your personal financial situation and goals?
Yeah, what are you taking away from this deep dive? Are there any specific actions you're considering taking based on what we've discussed?
It's all about that safety net, yeah. Having that cash on hand can really help you stay level-headed when the market takes a dip. You're less likely to make those impulsive decisions that could hurt you in the long run.
It's like that saying, right? Don't make permanent decisions based on temporary emotions.
Exactly. Okay, so moving on, Stefan's really big on diversification, which I know is classic advice, but he makes some really interesting points about why it's so crucial right now.
Yeah, don't put all your eggs in one basket.
Right, but it's more than just that. It's about spreading your investments across different asset classes, stocks, bonds, real estate, maybe even some precious metals or commodities.
So like if the stock market tanks, your whole financial world doesn't come crashing down.
Exactly. And it's not just about different types of investments either. He talks about diversifying across different sectors of the economy too.
So not just putting all your money in tech stocks or something.
Right. Think about the dot-com bubble. If you had all your money in tech back then, well, you would have lost a lot. But if you had some healthcare stocks, some consumer staples, things like that, you would have been in a much better position.
He even suggests looking at international investments. He says sometimes those emerging markets can really outperform the U.S. markets.
That's right. It's all about spreading that risk, not keeping all your eggs in one basket, as they say. It's really about understanding your risk tolerance, too. How much are you comfortable with?
Okay, got it. Now, this next piece of advice from Steven really surprised me. He actually says to keep investing even when the market is going down.
I know, it sounds a little crazy, right? Like trying to catch a falling knife.
Exactly.
But it's a core principle of value investing. The idea is that when prices are down, you have the opportunity to buy assets at a discount.
Okay, so it's kind of like bargain hunting.
Yeah, exactly. You're looking for those good deals that will hopefully increase in value over time.
So it's not about trying to perfectly time the market, but more about being patient and sticking to your strategy.
Right. Trying to time the market perfectly is almost impossible. Instead, it's about consistently investing over time, riding out those ups and downs. You could even think about increasing your contributions when the market is down, to take advantage of those lower prices.
Interesting. But it still seems nerve-wracking, buying when everything seems like it's falling apart.
It definitely goes against our natural instincts. We see prices dropping and we want to get out before we lose even more. But Stefan makes a really interesting point about human psychology.
What's that?
He says that the same fear that drives people to sell when the market's down also keeps them from buying back in when it starts going up.
Oh, so they miss out on the recovery completely.
Yep. It's called loss aversion, and it basically means we feel the pain of a loss much more strongly than the pleasure of a gain.
So even though they might be buying low and selling high, emotionally, it feels safer to just get out altogether.
Exactly. And that's where discipline comes in, sticking to your plan even when things get emotional. Remember, the market has always recovered from downturns in the past. It might take time, but history is on your side if you stay in it for the long haul.
Okay, so far we've got the emergency fund, diversification, and continuing to invest even when it's scary. Anything else on Stefan's list of survival tips?
He really stresses not panicking and selling everything when the market drops. It's natural to feel scared when you see those numbers going down, but selling out of fear can really lock in those losses and prevent you from participating in any future rebounds.
Right, it's like if you sell everything when the market's low, you've essentially made that loss permanent. If you stay invested, you have a chance to recover.
Exactly. It's about stepping back, breathing and looking at the big picture, making those decisions from a place of logic, not fear.
So how do you actually avoid making those impulsive moves when the market's going haywire?
Well, Stefan suggests focusing on what you can control. Things like your savings rate, your investment choices, your spending habits. You can't control the market, but you can control your own actions.
And I guess having a solid financial plan in place can help too, right? So you're not just flying by the seat of your pants when things get turbulent.
Absolutely. Having that plan, writing it down, it can really help you stay grounded. It keeps you focused on your long-term goals and reminds you why you're invested in the first place.
Okay, so we've got the emergency fund, we're diversifying, we're staying calm and not panic selling. What else does Stefan recommend?
He also talks about the importance of having a steady income, staying out of debt, especially those high-interest credit card debts, and keeping your short-term savings safe and easily accessible.
Yeah, he really warns against borrowing money to invest,
Yeah.
especially when it comes to risky stuff like stocks or crypto.
Right. Using margin or leverage can really magnify your losses. It can be tempting to try to get rich quick, but it can also backfire spectacularly.
Definitely not worth risking your financial future for a quick buck.
Exactly. And then there's the idea of keeping your short-term savings safe. What does that even mean?
Yeah, break that down for us.
It's about keeping the money you'll need in the next few years in a safe place, like a high-yield savings account or a short-term certificate of deposit, CD. Those offer a lower return than the stock market, but they're much more stable.
So if you're saving for like a down payment on a house or a big vacation, You don't want to put that money in the stock market where it could lose value in the short term.
Exactly. You want to keep that money somewhere where it's protected from those market swings. It's about matching your investment to your time horizon.
Got it. So Stephen lays out a pretty clear path for dealing with all this market uncertainty, huh? He's all about staying calm, sticking to your plan, and making those smart decisions based on your own situation and goals.
He also admits that all this advice might sound kind of boring, but that's because it actually works. The slow and steady approach to investing has a pretty good track record.
Yeah, he even makes this bold statement about how if you just hold on to the S&P 500 for 20 years, you're pretty much guaranteed to make money. He backs it up with data, too, saying that in any 20-year period, the S&P 500 has never had a negative return.
It's a powerful point, for sure. It really shows how important it is to have that long-term perspective. But we also have to remember that past performance doesn't always predict the future. There are no guarantees when it comes to investing.
Okay, but here's what's confusing me. If he's so sure about the S&P 500 over long term, why is he warning people about all these market risks? Seems like a mixed message.
It's a great question, and it highlights the difference between long-term trends and those short-term ups and downs. The stock market tends to go up over long periods, but there can be some pretty big drops along the way.
So he's not saying that the market can't have a big correction, like a 20% or 30% drop.
Exactly. He's saying that even if it does, historically speaking, it eventually bounces back, and over the long term, you're likely to come out ahead.
Okay, so it's not about trying to predict every little wiggle in the market. It's about building a financial foundation that can withstand those bumps in the road.
Exactly. His message is about resilience, being prepared for whatever comes your way.
Don't panic. Stay the course. Focus on what you can control. Sounds like a pretty good mantra for life in general, actually.
It applies to a lot more than just investing, that's for sure.
So, to sum it all up, we've talked about a lot today. Tariffs, the stock market, the Federal Reserve, Bitcoin, and of course, all of Stephen's advice for navigating this crazy financial world.
It's a lot to digest, but hopefully it gives people some food for thought and some practical steps they can take to feel more secure and confident about their financial future.
Absolutely. So what are your biggest takeaways from all of this? What really stood out to you?
Yeah, it's definitely reassuring to hear that kind of long-term perspective, especially when the news is full of doom and gloom. But there's this one thing Stefan said that's kind of been bugging me. He's so confident about the S&P 500 over 20 years, right? Like he practically guarantees you'll make money. But then he throws out this question, like, what could actually shake that assumption?
Yeah, that's where it gets really interesting, right? We can look at the past and feel pretty good about things, but the world's always changing.
So what kind of curveballs could throw that whole 20-year S&P 500 thing off?
Well, think about it. What if we enter a period of super slow growth, like almost no growth for years, stagnation they call it? Or imagine if inflation just keeps spiraling out of control, eating away at the value of our investments.
Yeah, that would definitely change things. And what about those big global events, like wars or another pandemic, something totally unexpected?
Absolutely. Those can have a huge impact on the markets, and we can't predict when or how they'll happen. So it's a good reminder that even when we think we've got it all figured out, there's always some level of risk.
Right. And it's not about being all doom and gloom. It's about being aware that the future is uncertain. And as investors, we need to be prepared for those unexpected turns.
And just burying our heads in the sand and hoping for the best.
Exactly. Informed investors understand that risk is part of the game. It's not about eliminating risk entirely. It's about managing it intelligently. Diversifying your portfolio, staying informed about global events, having a financial plan you can adjust.
So being flexible and ready to adapt, not just sticking to the same plan no matter what happens.
Right. Because the financial landscape can change quickly. The best investors are those who can change with it.
So what's the big takeaway for everyone listening? It sounds like complacency can be pretty dangerous. We need to stay curious, stay engaged, and keep learning.
Absolutely. It's like you're the captain of your own financial ship. You need to be watching for those storms on the horizon, and be ready to adjust your course.
So keep questioning, keep learning, keep challenging those assumptions, and think for yourself.
Exactly. The financial world's always evolving. The more you know, the better you'll be able to navigate it.
Well, that wraps up our deep dive for today. We covered a lot, from tariffs to the stock market, the Federal Reserve, Bitcoin, and all of Stephen's advice for staying afloat. Hopefully, you're leaving with some new insights and some practical ideas for your own financial journey.
Absolutely. Remember, knowledge is power, especially when it comes to your money. The more you understand, the better decisions you'll make.
So keep learning, keep those questions coming, and maybe you'll discover some brilliant financial insights of your own. Join us next time for another deep dive into a topic that's caught your attention. Until then, stay curious.